Natale is the head of our debt markets in Europe. Natale, what's your sort of view on Chris's comments there in terms of the liquidity of the US market? Are we going to see more liquidity in the debt markets in Europe? Is that going to free up the secondary markets, as we've heard, are very constrained by debt? Question.
Well, the market is very polarizing in Europe, and it's quite interesting the slides that Peter's put up, and saying that 40% of the investors that we surveyed actually they can't secure any debt they require, and the rest, other 45%, they cannot secure the debt they require. There is no availability for what they want to buy. It's another proof that the market is polarized between lenders who want to mainly finance core plus type of properties, and there is a very little availability for secondary, more tertiary stuff. This is the current situation all across Europe, but slowly it's changing. The market is improving a little bit, and we have more and more lenders and diversified lenders coming into the market. We are seeing different insurance companies coming into the market, especially from North America. And now, as in those days, we are seeing the rise of senior debt funds that will impact the market as well. This trend is started from the UK, where we have the largest pool of insurance companies lending against properties there. And some of them, they are looking at Europe. It's still a limited amount of insurance companies, but this is, again, it's an improving trend. And the next coming lenders will be, again, senior debt funds that they are ramping up their programs at the moment, and they are out there in the market raising equity. So it is very interesting, the situation that we have right now in Europe, and the outlook that we'll have for the next few years.
Johnny, I might mention that you mentioned American life insurance companies. MetLife, for instance, is rapidly expanding their presence in Europe because the yields are so constrained in the States, even though the values are quite safe. They're looking to expand their presence in Europe and are quite enthusiastic about it. I had lunch yesterday before leaving New York with the head of AIG's global real estate group, and they're now back on their toes. They are also looking to start lending in Europe because they see the same opportunities.
Just the gap, they just see the fact
just
there's
a
no
dislocation
debt.
and inefficiency in the system where they can play a major role and have secured investments in Europe.
What about the Spanish banks, Adolfo? I mean, is that something you're seeing day to day? Is that changing? Clearly, the debt market there is very difficult.
It's a major opportunity, for sure. The banks are not able to increase their exposure at this moment in real estate. Their mandate is to reduce it very, very clearly. Therefore, even transactions that they would be ideally wanting to do, they cannot afford to do. So in terms of risk return, I think probably as one of the smartest analysis that can be done for investment in Spain, because the lack of available debt, new debt, offers very, very good risk return, especially in very good assets. We talk about the sale of Torre Picasso, a very major asset, 400 million euro deal in the CBRE in Madrid. There was a very clever structure of new debt in place, which was more or less set up with the insurance group money. But the thing is, sometimes it takes more time to structure this kind of deal.
Yeah.
So unfortunately for this kind of a structure, there was a buyer that was a very rich, high net worth individual that managed to do it without debt. But I think that will be more the exception, and I think all around Europe, in Spain for sure, there is a big opportunity for some of these companies to make a good return.